So for those that have not heard any of the kind of market turning point stuff, supply and demand stuff that I typically talk about, you can always go and review. There are plenty of FXStreet recordings, and you can always go and review those, and there's plenty of basic information there to get you caught up to speed. And if you have any questions on that, you can certainly email me anytime, and I'll do my best to help you out. You know, the things that I always focus on, really the thing that I always focus on is market turning points. In other words, where is a market most likely to turn? If you can get that part right, everything else, you know, you can make everything else work. If you can't get the market turning points right, you know, it's almost impossible to get any other piece of the puzzle to work. You know, your stops and your targets and your position size, all those things. You know, it really comes down to identifying where markets are most likely to turn, and then taking your low risk, high opportunities there in the Forex market. Well, there's one. Let me just tell you a quick little more information there. One of the questions I get most often is, well, why did you pick that market turning point? You know, why did you pick that supply or demand level, but not these others? And you get that question quite a bit, and we're going to answer that today. The other thing is, I can tell you in the trading program that we run at Online Trading Academy, you know, sometimes, you know, there's people that do very well. There's people that, you know, some people, you know, do okay. Some people kind of just tread water, and maybe they're not losing money, but maybe they're not making much money, and they want to make more. And that's a group of people that, you know, eventually, sometimes if there are enough questions and things like that, I'll always offer to them, hey, let's jump on the phone. These emails are getting long. Why don't we jump on the phone and figure out what the issue is? So I'll do that occasionally, and I can tell you there's a reason for this story, by the way. And what happens is every single one of those ends up, you know, I always go right into two things. Number one, do you have a very rule-based strategy? Most of them are in the program, so they're looking for the market turning points and odds enhancers and all that. And so I say, you know, how defined are your rules for you know, strategy? And of that group, a number of people, you know, have a pretty good plan in place. And of that group, you know, I'll say, my next question is, well, are you following your rules? How's your discipline? You know, are you doing what you say you should be doing? And half the group will say yeah, and the other half of the group will say no. But when it comes down to it, the people that really have the strategy down, have put the time in to do their trading plan, and really have a mechanical set of rules, and are very disciplined, right? You know, now you would think those people have the best chance, and they do. But here's the point. Out of that group, there is almost always one very important piece of the puzzle that's missing. It's a rule that they often ignore. And what I find during that phone call is it's something they haven't even considered. So I'll say, all right, so tell me, you know, when do you buy? We'll say, well, maybe they'll look at, we're looking at the euro here. We can look at any market. It really doesn't matter. Let me pull up something a little bit different, because we always look at the euro. Let me capture the screen for you, and I'll show you exactly what I'm talking about. And we're going to spend our whole session on this one rule, and I think this will end up being a really good filter for you when it comes to identifying market turning points. So there you should be able to see the U.S. Canadian there. There we go. Okay. All right. So they'll say, well, I look, or I'll say, you know, when do you sell short? You know, give me your rules for selling short. They'll say, well, step one, find a supply level. So maybe they'll find a level like this. I'm just going to draw this in, and I'll share it with you here. Maybe they'll find this rally-based drop level right up here. And let me capture that for you so you can see it. So they'll say, well, I find a supply level, and then once price comes back to that level, I sell short at the bottom black line that you see there. You should be able to see the chart. And I put my stop above the top. And right when they start saying that, I always stop them. I say, whoa, 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 you're like a number of steps ahead of me. And I really press them in identifying, what is your sell setup. And what they're always missing, here it is. It's defining a supply level. People don't spend enough time or go into enough detail on really defining what a supply and demand level is. When I get the question, hey, Sam, I understand why you picked the level you did. Maybe not this one. Okay. Oops, let me get you the Canadian chart here. Sorry. Did that do it? Did you get it now, the Canadian? All right, just a second. Oh, so now it came through? Okay, yeah, I think I turned we're using the different camera for this. Sometimes use the still camera, sometimes use the timed application one. I get a little confused with that one, but all right, we have it now. So someone will say, well, I understand why you took the demand supply level you did, but what about all these other supply levels? And here's the whole point. The one rule that most people don't even consider is what is a supply level, for example, for you, okay? And it really has to be defined, okay? And what I mean by that, and let me tell you, out of every, let's say, I don't know if these are exact numbers, but they're probably pretty close. Out of every 10 supply or demand levels that I'll find on a chart, I'm probably only taking 2 of them. You understand what I'm saying? It's because the other 8, for example, don't meet the definition. And here's the biggest point. Okay, for example, this supply level that I've drawn in. Okay, I probably what you want to measure. Okay, what you want to measure is this. Let me draw something else in for you. Okay, this is the whole thing right here. We'll spend our whole session today on this. We'll look at different markets. Okay. What you want to measure is once price leaves the level, okay, in other words, the initial drop from that level, once it leaves that level initially, okay, shading in the area here for you, how far does it go before returning back to the level for an entry, okay? And for me, a supply level, for example, only becomes a supply level if the initial drop from that level is at least 3 times the distance of the level. Okay, so if you see the distance between the 2 black lines there, that's going to be the risk, right? Selling short when price revisits the bottom black line with a protective sell stop above the top black line. Okay, that's the risk. But the shaded area, that shows me how far price moved away from the level before returning back to the level. And that should be, for me anyway, at least 3 times the distance between those 2 black lines. Does that make sense? Everybody understand that? Yeah, you're right there, Jose. So let me bring this up to right there. Yeah, this is what I was. There you go. Okay. And we're going to run through a bunch of these. Okay, I just grabbed the chart again. So what I've done there is I've marked the lowest low right after price left the level, okay, before price returned back to the level, that little wick up there, okay? So for me, that has to be at least, that gray shaded area has to be, the length of that shaded area from top to bottom has to be at least 3 times the distance that's between those 2 black lines, meaning that I'm offered at least a reward to risk scenario of at least 3 to 1. Now here's the thing: If it doesn't meet that minimum requirement, that is not a supply level for me. I don't define that as a supply level that I would take. Okay? All right? And then, all right, great, Gillies. Hopefully that's working for you. So, okay, so given that, now you might say 2 to 1, 3 to 1, 4 to 1, whatever. Of course, the higher the risk reward, that the higher the threshold you put on this, okay, the bigger the risk reward, and also the higher the probability. Okay, so probability and risk and risk reward, I should say probability and profit margin really go hand in hand. Okay, all right. So now let's take a level a little bit higher. So this one may or may not meet. We can, this doesn't look like it is exactly 3 to 1. It'd probably be close. If it is, I would take the trade. If it's not, that does not even meet the definition of supply for me. Okay, because often we talk about, how did prices leave the level? Did they leave in strong fashion or not? And that's very important, right? Especially when you're dealing with the probability, the odds of the trade working out. But how far price moved away from the level, that is the most important rule when it comes to just defining a level. Remember that the biggest mistake that people make is they think every every rally-based drop or drop-based rally is a level, and that could not be further from the truth. So now let's move higher and take the next supply level that we see here, and let's do this to a number of different markets, and we can do it to different time frames too. Okay. So as soon as prices leave, and I'll capture this picture for you. Okay. So what I've done here is I've moved my 2 black lines to the next higher supply level, and I've shaded in so far the distance from the initial drop in price, which, let me actually just put circles on this so you're crystal clear. I'm not going to do this on every chart, but hope that's not going to work. Okay, I think you can. So yeah, from the initial drop in price to the lowest low from that level. So now, has this one met the minimum requirement of 3 to 1 for me? Yeah, for sure, right? It's way more than 3 to 1. So there's no question for me here. I would take that trade. Next step, I would look at how prices left the level, and that was a pretty dramatic drop. So that's good. That's an odds enhancer. But remember, we talk about those odds enhancers, and are they important? Absolutely. But are any of them in and of themselves kind of deal breakers? Probably not. Right? I mean, the profit margin a little bit, but this, what we're talking about right here, this is a deal breaker for me. In other words, for a level to even be called a supply or demand level for me, it has to meet that minimum threshold of moving away from the level at least 3 times the distance of the level. Okay? And again, the farther price moves away from the level before returning back to the level, obviously that means a big profit margin. But remember, what goes hand in hand with profit margins is probability. What I mean by that is the bigger the profit margin, right, the bigger this initial move, the more the rubber band is stretched. The further you are from equilibrium, right, the further out away you are, closer to price levels where supply and demand is way out of balance. Okay, and we're only going kind of this deep into it because this is a premium session, and right, if this is kind of just newbies, we wouldn't be talking about this because people, I think, would be confused. Yeah, 3 times the initial risk, Daniel, exactly. Okay. All right. So yeah, so that would all right. And what you want to do is decide what the minimum requirement is for you. Maybe it's 2 to 1, maybe it's 5 to 1. Who knows? Okay. All right. Yeah, so we can map out a long entry now. So let me get rid of these, and let's go and find a long entry. Let's go to a larger time frame because we don't really have any demand that shows up near term on this chart. So let's just back out to a little bit bigger time frame. and then I'll capture the chart for you, and we'll do it. This will just take a minute. Let me just get this for you. It's a little tricky. We have to go to a larger intraday time frame so everybody can see this on one chart. And when you bounce around time frames like that, what you're doing is, you're really, hang on 1 second. There you go. We're just taking kind of an X-ray snapshot, right? And I'm trying to back up and make sure I don't miss any questions or comments. Yeah, it's all personal preference for your risk-reward ratio. And don't forget, what goes hand in hand, again, with risk-reward is probability, okay? All right, so let's take a look, and let's do it here on the demand side now, okay? So remember how we do this. So everyone should be able to see the larger intraday time frame chart of the U.S. Canadian here. I've got it up. So what we do very mechanically, right, we start with current price, which we see over here to the right, okay, and we simply scroll down and go left without cutting through candles. We don't ever cut through candles. And when I do that, I arrive at this little level down here at the bottom. I'm going to draw some lines around it, and then I'll shade in that initial move again. Now, this one's going to be kind of obvious. I probably don't even need to shade it in, but let's do it anyway. All right. Yeah, you can always watch the recorded sessions. There's plenty of them. And okay. So this is a tiny little level, which is very ideal. Okay. And so now I've mapped out, the level itself, putting our lines in. Remember, based on rules. Bottom line at the low price in the area, top black line right at the top of the candle bodies there. And then the shaded area shows us how far prices left the level before returning to it. Okay? Just reading back here for a second. All right, so obviously this meets, way more than that minimum threshold, and that would be okay. Okay? But there's plenty of times where it's not going to meet that minimum threshold. In fact, often, I'd say probably half the time, whatever minimum threshold you come up with, that's not, the level you're looking at is not going to meet, it's not going to meet that. So, all right. And in the times that it does, it still doesn't mean that every trade's going to work out, but you certainly it's giving you the best chance, right? Anise, let's see, you're asking a question here, how to use candle signals in light of these supply and demand levels. So when you say candle signals, you mean like conventional candlestick patterns like dojis and things like that? I think that's what you're asking. You don't need to use those here when we're doing this, but if you have a favorite candlestick pattern, you can always look at that or look for that, when prices kind of come into I'll just circle kind of your entry zone here, right? So once prices come into your zone there between your two black lines, for example, if you get a doji candle, in your demand zone, it's certainly a higher probability setup than if you get a doji candle, anywhere on the chart, not in a turning point, in a turning point area. So whatever your favorite, are you looking for, whatever your favorite candlestick pattern is, again, you're gonna be able to, a good filter for taking those types of entries is where are those candlestick patterns showing up? Location, 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 that's everything. All right. Okay. So I think you get the point there. We can move on to a different market. It really doesn't matter which market. If you have one you want to look at, I can pull it up. And we're just going to focus on our near-term supply and demand levels. We'll look at large time frames, smaller time frames, and we're going to focus in on this point. And I think you'll see that, all right, let's look at the pound, John. I think you'll see that, not every one is going to meet our criteria. Okay, so let's look at the pound dollar. Let me just read back here for a second, sorry. I don't want to miss anything. Yeah, Jez, remember, when prices get to your best demand levels, your best turning points, for example, that's always going to happen in the context of a downtrend in some time frame, right? So you're always going to get some lower lows into that level. One of the biggest I would say, the biggest misconception in trading, whether it's short-term trading, long-term trading, is that this is somehow different from how we buy and sell things in other parts of our life, right? In other words, and this is what I find amazing, when prices like collapse, right, really drop to one of our really key demand levels, and we've had a lot of them here, and we've looked at FXStreet over the years, and when prices get down to those points, the vast majority of people don't want to buy because they see prices falling, they see a downtrend is underway, even though it's at a key demand level, right? The news is bad, all that other stuff. People just don't want to buy, right? Because of what some people look, or what people are saying here. Well, why would I buy if it's kind of in a downtrend? You have lower lows. Even though it's hitting a demand level, can't go right through it. However, if you take that same person and you take them into a store where, I don't know, it could be anything. I'll use the example from an article I wrote. Anybody that likes avocados, right? If avocados are selling for $1 a piece, and all of a sudden you drop the price to 25 cents an avocado, those avocados, how long is it going to take for those avocados to be sold out? If you drop the price from $1 an avocado to 25 cents an avocado, how long is it going to take? Anybody who even remotely likes avocados, they're going to buy those things up. It's probably going to take a few minutes. They're going to all be gone. But you take that same person and put them in a trading environment, and price collapses to a demand level. Again, the $1. Let's go this way. Let's say you chart that avocado, right? And you say, you know what? Instead of buying the actual avocado in your hand, you have to do it through the chart, right? No one's going to want to push the buy button. Does everybody understand that? It's the same thing. Yet people have take complete opposite action, but there's really no difference. You see what I'm saying? I don't want to get off on too much of a tangent there, but it's so important. Okay. How far to put the stop? Yeah, we'll talk about that when we map this one out. Okay, so let's deal with the first. We can deal with supply first. So when we're looking for supply, again, we're looking for the last area on the chart where prices could not stay at and had to drop away from, right? Where was the origin of the last decline in price on this chart? Let me just mark it off for you. Okay. So if we're following our rules for how we draw our lines, let me just show you. Okay. So I've marked off the supply level, and I've also shaded in how far prices have dropped away from the level, from the origin of that drop, right? So now, does this meet the minimum requirement that we're looking for a trade so far? Right. Well, for me, it hasn't, because it hasn't. I don't have 3-to-1. It hasn't had a drop from this level at least 3 times the size of the level itself. So I would not call this, for me, this is not a supply level. Okay. The picture may look okay. We have rally-based drop, and it is a nice strong drop out of that level. Prices may certainly go up there and turn lower, but again, for me, I would not define this as a supply level that I would take. Okay. All right. Let's see. Yeah, so Daniel, you're asking a really good question there, and the answer is, and I think another way to say that question is, when do you actually, in other words, when do you stop calling this? Price did turn to the left here, right? You're talking about the pivot high to the left, and now we've got another one here. So, when do we stop calling this a supply level? How many times at this level? And the answer is, if you've been in sessions where we've run through our odds enhancers, we go through this probability scoring, right? We rescore these every time we have a level. So when I have rally-based drop here, Daniel, like we do, I would score this out again. I would run through our little checklist, make sure it meets the minimum requirements of what we're looking for, and as long as it does, I would take it as a new, fresh level, okay? And if it goes back up there and does the same thing again, I would take it again and again and again. As long as it keeps scoring out, right, if you remember our our odds enhancers, as long as it keeps scoring out to a probability score that is, okay for us and our trading plans, right? Then we take it, okay? But that's the beauty of this, is that once there really is not a lot of supply left up at that level, it's impossible to get a good score. You see what I'm saying? In other words, the chart will tell you when to stop shorting rallies into that price level. Okay? All right. So this supply level does not score out to a supply level that I would take. At least it doesn't yet. Now, an hour from now, price may drop a ton more, and this may score out to be this may meet the minimum requirement. But right now, it doesn't. Okay? However, when I look at this level up here, I'm going to draw on another level. And let me just do that. And so I'm saying, just as of right now, the next shorting opportunity that I would take if price started to rally would be that one. There you go. So I just moved the lines to the next highest supply level, and I've also shaded in how far prices have dropped away from that level. And here we have more than 3 to 1. So this is a level that I would be interested in taking. Okay? But that other one below, it just doesn't meet my minimum requirement yet. It may meet someone else's minimum requirement, but it doesn't meet mine. So it does not become a supply level that I wouldn't even call it supply for me. It doesn't meet the definition. Okay? As far as demand goes, okay, let's see. Yeah, so Jez, anything we're talking about here and anything in those prior recordings that you may spend time on are equally applicable in any time frame, any asset class, any market. Okay? We're just talking about the pure concepts, foundation concepts of supply and demand here. Remember, at the end of the day, prices are going to turn at price levels where supply and demand is out of balance, right? Okay? Yeah, people say, well, there's no volume in spot Forex, and wouldn't it be nice to know what the banks and dealer desks are doing? We can see all that, right? We can't see the exact details of that, but we can see basically all the information we need to know by looking at the price chart. You want to see where an institution has a lot to sell or a lot to buy? Wouldn't it be great to see those price levels? It's on the chart, right? Find the price levels where prices could not stay at and screamed away from when they were there. And then just spend 2 minutes thinking to yourself, why did that happen? Why could price not stay there? Why did it have to scream away as it did? It's because behind the scenes, there's a huge imbalance of buyers to sellers, okay? The chart gives us all the information we need if we know what we're looking for. What makes this so difficult for people is that, instead of thinking in kind of the simple terms of how and why prices move in a market, which most of us could probably all just figure out by thinking about it, instead of doing that, what most people do is they take kind of the academic route to this first, right? And I'm going to draw some more lines in here while I'm talking. They take the academic route first, and they're looking for all these, conventional this and conventional that from the textbooks, but that's very different from real world trading. Okay, conventional technical analysis is a very lagging and high risk school of thought. Okay, so let me grab this one for you. So Ed, finding 3 to 1 may take more time and less frequent. You could go to smaller time frames and you'll find more if that's what you're looking for. Okay. Okay. All right. So there's a nice little demand level below, and let me kind of read back here. Let's see. Let's take a look. Yeah, so Daniel, I think you're talking about this level up here, and then prices come up here, and looks like they just by a, let's see, it looks like the high here is, let's see, 51. Yeah, they go higher by just a bit there. Now, this is a kind of a large intraday time frame. Remember, your stop is going to be, if you mark this off as a supply level, your stop's going to be, just above this level. So you're probably going to go, you're going to go, if this is a 30-minute chart, you're probably going to go on the pound. You're probably going to go 10 pips above that, right? Okay. Let me read back here. I just want to try not to miss anything here. Oh yeah, so let's go over that. Let's see. Let's go over that stop here. Sorry, I forgot about it on the last one. So yeah, so if you take this as a demand level, this one that I have on the screen now, you're putting your bottom line on the lowest low in the area. So there it is, and then you're probably going to want to be as mechanical as you can be about this, and pick a stop loss below that. 5 pips, maybe 5 to 10 pips at most. You definitely don't need more than that, I don't think. Most of the time you're going to see on your best levels, even 5 pips is plenty. So I wouldn't go far beyond that, but pick a number. I'm typically going with a smaller number of 5. Why does price move back to huge sell order levels if the big guys are at that level, right? They can be loser. Right, so Jack, so that's the thing. Remember, so my Daniel, yeah, it depends, Daniel. If you're on a small time frame, you might need a little bit bigger stop. If you're on a bigger time frame, like this, 5 pips is probably plenty. Okay. Let me refresh the chart for you here. Yeah, so why do prices even come back to these levels? Like, let's say this demand level down here, that some bank or some institution has a ton of demand there, a ton to buy. Why does price even come back there? So remember, I started my career on the floor of the Chicago Mercantile Exchange, and when you have a lot of levels, I started out working for an institution, and if you have a lot of, let's say you have a lot to buy at a specific price level, right? As long as price is at that level, you're fine. You can fill your orders. But what happens, the bigger the size of that order, the less likely you're going to get all of it filled. So what happens is you run out of sellers at that level and price moves away. So now you have a problem. You've only filled half your order and price is now higher. Well, what you might think of doing as an institution, right? You want to get long down there. You might consider shorting or selling some and trying to get other people in the market to sell some, right? If you're a consistently profitable, maybe you're a big institution that everybody knows makes money. Well, you start selling short, other people are going to start selling short. So institutions do things like that. Let me ask you this. Let me kind of ask you this. I don't want to step into territory that I shouldn't be talking about here. So instead of telling you, I'll do it in question form. When you see prices come into some of your best levels, let's say a supply level, right? If you think of the times when you've seen prices come into some of your best supply levels, okay? If you happen to have one of those, a broker who also provides news for you, market news for you, okay, everybody following me? So if you have a broker who happens to provide market news for you, and they're the ones providing the news, and so now think of your really juicy, really good supply levels. Do you ever notice what the news is as price is kind of, approaching that level? Is it bullish or bearish news, typically? Not always, but typically. All right, what do you think the news is when prices approach a kind of a supply level there? Anybody ever see that? Yeah, see, it's often it's bullish, right? And when price gets really close to that level and in that level, a lot of times what happens, it becomes very bullish, right? Does everybody see that? I mean, I'm not telling you anything you don't know. What do you think the reason is? Why do you think that is? Okay. You see what I'm saying? You can kind of read between the lines there, but so you've got to be careful. Remember, there are traders, institutions, brokers, banks, you name it. Anytime you push the button, there is somebody on the other side of that trade trying to take your money. Okay? So you have to really make sure you know what you're doing. Okay? Why would someone spit out bullish news into supply and bearish news into demand? It happens all the time. We see it all the time. It's anyway. Yeah, there you go. There you go, Jez. Exactly. So anyway, I don't want to. I don't even know if I should be talking about that, but anyway, I'm here for you and in your best interest. No one else's. So now remember too that some of the levels that we've looked at today. Remember, we haven't even touched on the other odds enhancers. So I haven't even looked at the larger time frame. In other words, like where is this demand level or this supply level on the levels we've looked at? So there's other things we haven't looked at here. So Daniel, make sure you understand that too. My point with today was to focus on this one very important rule and point for you, and it's making sure that when you say, yeah, my strategy is I buy at demand or I sell at supply, well, make sure that you define that supply or demand level and all right. So the other thing that you might want to consider doing, along with before you even call this a demand level that you're looking on your screen, right? So maybe you've seen, okay, it's definitely offering me way more than 3 to 1. But how much time did price spend at this level? Were there a lot of candles down here or just a few? Okay, that's another definition that you need to consider. And it's really the only other one. There's really, you can talk about others, but these are the two huge ones. So before you even think about any other details in the trade, position size or anything, make sure that the demand or supply level you're looking at is actual demand and supply for you. It's met your minimum kind of threshold requirement. So Boyke, where do we enter? The way that I do it is just simply entering at the top black line here, and then putting your stop just about maybe 5 pips below the level. And then, of course, we always adjust our position size to make sure that we're never risking more than we're willing to risk. If it's 1% of your account, adjust your position size to that. 1.5, half, whatever. Okay. But let me just tell you, in the trading room at Online Trading Academy, I can tell you there are members in that trading room that do it a little bit different. In other words, I'm thinking of some that enter half the position at the top black line. They enter the other half of the position, right in the middle of the zone, and then they put their stop again just below the bottom black line. Right? So it keeps the risk down a little bit, things like that. There's other ways that you can do it, but okay. Let me just try to catch up here. So targeting for the exit, again, when you buy at demand, your target, your first target is going to be your nearest opposing supply level. But again, that's why we always want to watch risk reward, right? We want to make sure that we have that minimum, maybe 3 to 1 or whatever you're looking for. Okay. False move at supply and demand levels. I see that question. I'm not exactly sure what you mean by false move. Once you see that the level has met your requirements, your rule-based requirements, it's not false. It's real. And then, if it's in your plan, just take it. Remember, if you're really sticking to your rules and sticking to the risk reward, even if you're only right half the time, you should be able to do pretty well. Of course, hopefully you can do better than that. But okay. Yeah. So once you have your level there, Eric, if you're going to do this, you're going to be a buyer on the first pullback into the level. Remember, that's one of our odds enhancers, number of retracements, right? We want to be, we don't want to take those latter pullbacks, third, fourth, fifth pullbacks, because there's probably not a lot of demand left. Okay. Okay. So let me do one more thing here for you. So there's my email address. I know we're kind of running out of time here, but again, I just wanted to spend our whole session today focusing on this very important point that before you get into details of strategy, make sure that you define what a market turning point is for you. And by focusing on what I've shown you here in the gray shaded area, this will hopefully force you to only trade out at the extremes where the odds are stacked in your favor, and you're kind of far from equilibrium. Okay. Yeah, if you email me, Daniel, I would send it again because I'm pretty caught up on emails. So I don't know what happened there. I'll look in the junk mail or the spam folder. But all right. Well, thanks for your time, everyone, and hopefully this was helpful. It's just, again, one piece of the puzzle to consider, but it is an important one, and it's also one that I find that most people don't consider. So just think about that, and hopefully it was helpful, and have a great day. Thanks for your time.